Testing, testing, testing. Hi, everyone. Hi, can you guys hear me? Okay. Um, Sorry I had to start the webinar a bit later. I was having technical issues earlier on. But anyways, I'm glad all of you are here now. Okay, cool. Okay, hi everyone. Welcome to today's webinar brought to you by IC.com. We are going to do risk management, the skill that keeps traders alive. So why staying in the game matters more than any single trade. So today's the 11th of August. It's about 1 p.m. here in Singapore. Okay, so if you guys have any questions or if at any point of time you guys cannot hear me or the screen's not showing, just let me know in the chat box. Okay, disclaimer. Anything I share in this webinar should not be construed as any form of financial advice, any form of investment advice, or any form of signal to get in and out of the markets. This is purely an educational webinar. Okay, so another risk warning: trading in securities involves significant risk and it's not suitable for everyone. So I'm gonna have to stay here for a few minutes so you guys can actually read through the disclaimer and then we'll continue again. Okay, cool. That's a few minutes. I think you guys that should be more than enough time to read through the disclaimer. Okay, let's continue with the introduction to your host. For those who don't already know me, my name is Cassandra. You guys can call me Cass. I am an investment analyst and a prop trader. So, yeah, what that means is that I spend a lot of time on the charts, basically researching, back testing, understanding where the markets are going, right? Forecasting and basically just understanding the economy to understand, to get good at trading so that I can become very profitable. Okay, so because I spend so much time on the charts, naturally that will bring me to prop trading. On the normal month, 6 to 10% is quite usual for me. So yeah, if you guys have any questions regarding trading or anything that's trading related, ask me in the chat box and I'll be more than happy to help you guys through this. Agenda for today. Position sizing, risk to reward. Okay. So that you know how to judge whether a trade is even worth taking. Then we'll talk about drawdowns, the math of losing, and why it's brutal if you don't respect it. And we'll close with the psychology side, because knowing the rules and actually following them under pressure are two different skills. Okay, so if you've got questions as we go, drop them in the chat and I'll pause between sections to grab to answer your questions, okay? All right, first up, position sizing. This is the most mechanical part of today's session, but don't tune out, okay? This is the lever that decides whether a bad trade costs you 1% of your count or 15% of it. So let's get into it. Okay, right. Let's start with what position sizing is actually doing for you. So it's not about how confident you are in a trade. It's about controlling how much damage any single trade can do if you're wrong, right? So, and you will be wrong because that's part of the game. Even a great strategy loses regularly. Okay, I've done backtesting and you can end up profitable, but you would still have to take a lot of trades before you end up profitable. Okay, so that's just the nature of probability-based decision making. The starting point most professional traders use is risking somewhere between 1% and 2% of their total account equity on any single trade. So can you guys let me know in the chat box what do you guys usually risk per trade? About 1%, 5%. Okay, that's a little high. 0.25%, that's actually very conservative. Okay, I personally risk 1% only. Okay, so say you've got $10,000 account and you're using the 1% risk rule. That means the absolute most you're willing to lose on this one trade is $100, right? So not 500 because you really like the setup. Not 1,000 because you're trying to make up for the slow week. $100 every single time, 1% every single time. It's not $100 every single time, but it is 1% every single time. So if your account grows, then the amount of money you are allowed to lose grows as well, right? It becomes bigger. But if your account shrinks to $900, for example, then 1% of $900 becomes 90. So here's why that number matters so much. If you're risking 1% per trade, you could lose 10 trades in a row, which does happen, to be honest. Even with a solid strategy, losing 10 trades in a row is a very normal thing. And you'll still have about 90% of your account left. So compare that to someone risking, I don't know, 10% per trade, three losses in a row, and they have lost 27% of their account. And now they need to do a 37% 20% gain just to get back to even. Same three losses, widely different outcomes, right? Purely because of position sizing. So how do you actually calculate your size? You need three numbers, your account size, right? Which in this case, we're gonna say it's $10,000. Hold on. Your risk percentage, so we're gonna do 1% every single time. And your stop loss. Okay, your stop loss distance. So let's say you have decided you are going to put your stop loss maybe 50 pips away for EUR USD, for example. So where a pip is worth about $10 per pip, right? At a standard lot. So $100, okay, let's say you're doing 50 pips. And each pip equals to $2. That means sorry, let's do each pip $10. Okay, that means you can lose you take 100 and you divide it by 50 and then divide it by 10. You take 50 pips and you divide it by $10 per pip. That gives you the size of about what? You take this and then you divide that with this, you get about 0.2, right? 0.2. So that's it, right? That's it. That's the whole formula. So your stop loss placement should come from market structure, not from working backwards from a lot size you already wanted to trade. So a quick gut check. Okay, does anyone here currently size positions based on a fixed lot size, regardless of the stop distance? That's actually okay. I want to know. Let me know in the chat box. Anyone has a fixed lot size they use every single time? Okay, yeah, so that's actually one of the most common mistakes that I see. And it's exactly backwards from how this should work. Your stop distance should determine your size, not the other way around. Okay? You need to decide where you're going to put your stop loss first, and then you can decide what your lot size is going to be. Okay? Okay, let's move on to the next part. Okay, let's make this concrete with a couple of real scenarios because the formula only clicks once you see it applied to different situations. Okay, scenario one, you're trading a $1,000 account. Sorry, $10,000 account, risking your 1%, right? So you're risking about what's that, $100, same as just now. So your technical stop based on the last swing low or last swing high, okay? You should put it at the last swing low or the last swing high here. Okay, your stop loss should either be a swing low at the swing low or swing high, depending whether you're going in for a buy or sell. Okay, it sits maybe, let's say, 30 pips away. Okay, so you take 100, you divide by that 30 pips. It'll work out to about what? 0.33 lot. That means you are entering at 0.33, okay? Clean and simple. It's very clean and simple. Okay, this is scenario one. Let's say you're doing scenario two. Same $100 risk, right? But now you're trading gold. And gold is far more volatile. So you stop needs to be, wait, let's say 300 pips away. Okay. You see how when you're trading Forex, it's like what, 30 pips away? Now it's 300 pips away. Right? Okay. The reason why you need to go so many pips for gold is because that way you can sit comfortably outside the normal noise for gold, because with gold there's a lot of like wicking, there's a lot of like it's quite volatile. So the same math, if you take 100 and you divide it by $100 and you divide it by 300, right? By whatever point value is, and because gold moves in bigger, more volatile swings, that position size comes out much smaller than this is USD, by the way. Okay, then scenario one, which is a Forex pair. Okay, that's the part that people get wrong. When volatility goes up, your instinct might be to tighten your stop loss so you can size up, but that's too tight, okay? Because your lot size, by the way, your lot size becomes like 0.03. Okay, so tightening your stop loss is not the right thing, okay? Because a stop that's too tight against a volatile instrument just gets you stopped out by noise, not by being wrong. Then stop should reflect the market's actual behavior. Okay, your position size is the variable that flexes, not your stop. Okay, that's the real trap. Okay, that I actually want to flag here. Let's say you find a setup that genuinely you're genuinely excited about it, and the temptation is to say, this one's different. I'll risk 3% instead of 1%. I get the temptation. I feel it too sometimes. Like you're really confident, you think this is a really great setup. Why don't I just risk more than usual? But conviction is not a risk management input. You don't actually know which of your trades will be winners in advance. If you did, you wouldn't need a stop loss at all, right? Right? Okay, so the traders who blow up accounts almost always point back to one oversized trade where they just knew they were right. Okay, they just knew they were right. So practical takeaway, pick pick your risk percentage. Okay, 1% is very, very reasonable, sustainable starting point, and apply it identically whether you're trading your setup of the year or your 50th setup. Okay, let your stop distance driven by market structure and volatility do the work of adjusting your position size for you. Okay. Okay, let's move on to the next part, which is position sizing that wreck mistakes that wreck accounts, right? Okay. Let's go through three position sizing mistakes I see the most often. Okay, because knowing what not to do is just as valuable as knowing the formula. Okay, mistake number one, doubling down. Okay, doubling size after a loss to try to get it back faster. Okay, it feels logical in the moment. Okay, you're down $200, so a bigger position gets you back to even quicker. But you've just increased your risk exactly when your judgment is most compromised by frustration. So if you've lost three 1% risk trades in a row and then doubled to 2%, then doubled again to 4%, on the theory that it's due for a win, a fourth loss of 4% risk does not damage that the first three combined. Okay, this is a martingale style sizing, and it's mathematically one of the fastest way to blow up an account because eventually you hit a losing streak long enough to wipe out, and markets don't care how overdue you feel a win is. Okay, mistake number two, ignoring correlation when you're holding multiple positions. Say you're long EUR/USD. Okay, long GBP USD and long AUD USD, each size at 1% risk. On paper, that's 3% total risk. Okay, so again, sorry. Say you're long EUR/USD, long GBP USD, and long AUD USD. Each size is at what? 1% risk, right? So on paper, that's 3%, but these pairs are all heavily correlated to broad USD strength of weakness. If the dollar rallies hard, all three trades can hit their stops at nearly the same time. Your real risk that day wasn't 3%. It was closer to full 3% landing on the same news event at all at once. So before stacking positions, ask whether they're actually independent bets or the same bet wearing different tickers. Okay, so mistake number three, sizing based on how confident you feel rather than the math. This is the this one, okay, because it doesn't feel like a mistake in the moment. It feels like conviction, like trusting your read on the market, but confidence in and being correct are not the same thing. And the market has no idea how sure you feel. The fix for all three is the same. Decide your risk percentage before you're in a trade, write it down, and treat it as non-negotiable, regardless of how the last trade went or how good this one looks. That consistency is what actually protects you over hundreds of trades and not a single smart decision. Okay, so next up, let's look at risk to reward. Quick check in the chat. If I told you a strategy wins 40% of the time, would you trade it? Okay. Hold that thought, okay? Because the answer might surprise you once you look at the math altogether. Okay? Okay. Why risk to reward matters more than win rate? This is so important. I think people don't know how important this is. Okay, there's the question I asked before we started this section. Okay, would you trade a strategy that only wins 40% of the time? Okay, would you win a strategy that only wins 40% of the time? Most people's gut reaction is no. Losing more than half the time sounds like losing strategy, but that instinct is missing the other half of the equation. How much you win when you win versus how much you lose when you lose. So the real formula that matters is expectancy. Your win rate times your average win minus your loss times your average loss, right? Let's compare two trades, okay? Trader A, okay, has wins 70% of his trades, has a 70% win rate of trades, but only makes $50 per trade, okay? Every time he wins about $50 per trade, okay? On winning while losing $150 per trade. That means out of 10 times, he wins 7 and he loses 3 trades. If he were to lose 3 trades, means he lose $450, right? If he were to win 7 trades, means he won $350. Bringing his net P&L before any kind of charges, right? Before any kind of overnight charge, any kind of commissions, every net spreads and whatnot, okay? He's lost about $100, okay, before anything else. Okay, but let's just assume this is net. Let's just assume this is after everything. Okay, so at the end of the day, right, he's losing about $10 per trade, or let's say $100 in total, right? They're losing money on average despite winning most of the time. While let's look at Trader B. Okay, this Trader B who has a 40% win rate, but every time Trader B takes a win, it's $300. Every time Trader B takes a loss, it's $100. Okay, at 40%, it means that they're winning 10 trades, sorry, 4 trades, and they're losing 6 trades, right? This is out of 10. So if you're only winning 4 trades, that means his Trader B is winning 1,200, but losing about, let me see, $600. Do you see how at the end of the day, Trader B is still winning $600, right? At the end of the day, Trader B loses more often and is significantly, okay, ends up significantly more profitable than trader A. So it's not about your win rate. It is not about your win rate. People get so confused with this. Professionals don't care about the win rate, they care about the risk to reward. Okay, this is the concept of expectancy, and it's the single most important number in trading that most retail traders never calculate. Win rate alone tells you almost nothing about whether a strategy makes money or not. Okay. Okay, now I'm not saying low win rates are automatically good. I'm saying that a strategy that wins 20% of the time needs an enormous reward multiple just to break even. And that's psychologically brutal to trade, even if the math works on paper, because you're stringing together losses most of the time. So the real lesson is before you take a trade, you need to know both numbers, roughly how often this setup tends to work, and what your realistic reward is relative to your risk. A 1 to 2, right? A 1 to 2 risk to reward or better risk to reward ratio gives you real breathing room because it means you can be wrong more often than you're right and still come out ahead over time. So quick question in the chat. Does anyone currently track their actual win rate and average risk to reward from their trade journal? Okay. If not, I think that's homework for the week. You can't manage what you don't measure, right? You don't know if you're winning or losing, so you cannot manage what you don't know, right? So knowing where you can improve is really important. So I guess for this week's homework, before I meet you guys next week, please. Okay, before I meet you guys, yeah, next week, please go and do your homework, do your tracking of your trading journal. Okay, guys. Sorry, give me a moment. I need about 2 minutes. I'll come back. Right, I just need to readjust. I just need to restart my Wi-Fi. I just got a notification saying that my connection is weak. Okay, so just give me a moment. Okay, cool. Let's move on to the next part. Um, Now that we know why risk to reward matters, let's talk about how to actually set a realistic reward target. All right. I think because this is where a lot of traders go wrong. They'll set a stop loss based on chart structure, which is good, right? But then set their take profit at some arbitrary round number. Like I'll close it at 100 pips higher or with no relationship to what the market is actually likely to do, right? So the better approach, um, I think, okay, would be your reward target just like your stop loss, should come from market structure. So the next meaningful resistance level, a prior swing high, a major round psychological level that price has respected before. Let's walk through an example. Okay, say EUR/USD is at 1.085. Okay, and you spot a clean setup and your stop loss, okay, below support at 1.08. Okay, this is your stop loss. This is your entry. That's gonna be about what? 50 pips, right? Okay, this is 50 pips of risk. Looking left on the charts, the next real resistance zone where price previously reversed twice is up at 1.095, which is about 100 pips away, right? So based on this, you've got like a 1 to 2 risk to reward. Okay? You got a 1 to 2 ratio, meaning you are risking 50 pips to make 100 pips. And it's not about arbitrary, it's based on whether or where the market has actually shown it's willing to react. So the mistake to avoid is anchoring your target to something meaningless to the market, like, oh, I want a $200 profit, or I'll close it at a nice round number. The market doesn't know what you want and doesn't care either about your account balance. Okay, it only respects supply, demand, and the level where large numbers of participants have previously acted. So if your honest read of the structure only gives you a realistic one-to-one reward to risk, then that's not enough for your strategy's win rate to be profitable. The right move isn't to force a bigger target, it's to skip the trade, which is exactly what we're covering next. Okay? Sometimes, walking away is winning. Okay? A lot of times, walking away is actually winning. Okay, so when to walk away from a trade. This might be the most underrated skill in trading, knowing when to walk away from a setup that looks technically fine but doesn't actually make sense on a risk to reward basis. Okay, a scenario that I see constantly is when price pulls back to support level and held twice before. Okay, very normal textbooks setup. Okay, this is a support, price is moving, comes here, reverse, comes here, and then reverse. Okay, so it came twice and then it held up. Okay, textbook setup. Okay, it looks great on the chart, but when you actually measure it out, your logical stop sits 20 pips below support, right? And the very next resistance level, the first place price is likely to stall, is only 15 pips above your entry, right? So this is going to be an entry. That's going to be a stop loss, and this is going to be a take profit. Okay, so that risk reward is about 1-to-1. Okay, the pattern is real. The setup is still bad because even if you're right about the direction, The reward doesn't justify the risk given how close resistance is. A good rule of thumb, if the risk to reward on a setup comes out better or below roughly 1 to 1.5, the seriously question whether it's worth taking. Even if every other signal lines up, you can be phenomenal chart reader and still lose money consistently if you keep taking trades where the math doesn't support your win rate. I want to normalize something here. Okay, passing on a trade is not a failure. It doesn't feel like a win the way a profitable trade does. So a lot of traders treat every skipped setup as a missed opportunity and end up forcing trades just to feel like they're doing something. But professional traders pass on far more setups than they take. Your job isn't to trade every pattern you can identify. It's to trade the ones where the numbers actually work in your favor. So practical exercise for after this session, pull up your last 10 trades and calculate the actual risk to reward you took on each one, not what you intended. You might be surprised how many were close to 1-to-1 or worse, and that's often the real reason a solid strategy still isn't showing profit on the account statement. Okay, so now let's talk about drawdowns. Right? The part of trading nobody wants to plan, but for everyone, eventually you will have to live through it. Okay, and the math here is genuinely counterintuitive, so stick with me. Okay. The next part surprises almost everyone the first time they see it laid out. So let's go through the actual numbers, okay? If your account drops 10%, right? How much do you think you need to gain to get back to where you started? You're gonna have to gain 11.1% to get back to where you started. If it drops 20%, you need to get back 25%. Okay, I'll explain this concept in a while. So the more your account drops, the more you have to gain back. Okay. Okay, and here's the one thing that really lands, okay? It drops 50%, you don't need 50% to gain to recover. You need a full 100% because you're now recovering from a small base. So you lose 50% and you literally have to double down your remaining money just to break even. Okay? Because you think about it, right? If you have $100, okay, so why is it when you lose 10%, you now need to make back 11.1%? Because let's say you have $100 and you lose 10%, meaning you lose $10, right? Now you have $90 left. If you make back 10% on $90, you're only making $10. Sorry, you're only making $9. That does not bring you back to the $100. You need to make 11.1% on the $90 to bring you back, right? To bring you back to $100. You see why when you lose, coming back, you need more to come back. Okay, it's not as simple as I lose 10%, I need to gain back 10%. Okay, no, because when you lose 10%, your account shrinks and now your base, you have to make back what you lost based on the now shrunken account. Okay, why does this happen? Because percentage losses and percentage gains are calculated off different bases, right? So Again, if you have a $10,000 account, right? You have a $10,000 account, you lose 50%, you now have $5,000. To get back 10,000 from 5,000, that's a 5,000 gain on a $5,000 base, right? So now you need to make 100%, even though you only lost 50%, because now your base has decreased. So the math doesn't care if it feels like it should be systematic. This is exactly why position sizing and risk management is so important. Because if you lose fast, you're gonna take a lot to have to gain it back, okay? Which we covered earlier. So it matters so much. It's the thing standing between a manageable drawdown and one that requires a heroic, often account destroying effort to recover from. So a trader risking 1 to 2% per trade might see a rough stretch take their account down 10 to 15%, which is painful but very recoverable with normal disciplined trading. A trader risking 10% per trade can hit that same rough stretch and be down 50% or more, and now needing to double their account just to get back to zero. Okay, so as anyone here, let me know in the chat box, actually calculated what percentage gain they need to recover from their worst drawdowns. Okay, if you haven't, it's worth doing. It tends to be a sobering, very motivating exercise for actually respecting your risk limits going forward. Okay, if you don't respect your risk limits, you are the one that is going to, I would say, suffer, right? Okay. Okay. So we've covered the mathematical side of drawdowns. Now let's talk about what they do to your decision making, because this is usually the more dangerous half. Here's how the spiral typically starts. You take a normal, well-planned loss, nothing unusual, right? Just part of trading, but instead of moving on, you immediately look for the next trade to make it back, right? And because you're now trading from a place of frustration rather than analysis, you either skip steps in your process or size up beyond your normal risk. And the next trade often loses too because you weren't actually following your edge, you were chasing an emotion. Now your two losses deep and the urge to force a third trade is even stronger. Okay, this is revenge trading, and it's one of the most reliable ways to turn a normal healthy drawdown into a catastrophic one. Okay, here's a second quieter version of this same problem. Tightening your stop out of fear. Okay, so it feels responsible. when you tighten your stop out of fear, I'll just risk less distance so I can't lose as much. But if your stop no longer reflects actual market structure, you're not managing risk anymore. You're just guaranteeing you get stopped out by normal volatility before a good trade has room to work. Okay, so you end up with the worst of both worlds. You still take the loss, but now you've also cut off trades that would have worked if you'd given them proper room. So a third pattern worth naming, after a drawdown, a lot of traders unconsciously start trading more frequently, taking marginal setups they normally skip, purely to generate the feeling of being active and back in control. More trades taken from a place of anxiety rarely means more good trades, usually the opposite. Okay, the core insight here is that drawdowns don't just cost you money directly, they degrade the quality of every decision you make until you consciously interrupt the spiral. So recognizing you're in it is the first step. And it's exactly where we need an actual rule for when to stop, which is what we're covering next. Okay, so let's turn everything we just covered into something you can actually implement this week, a drawdown circuit. So the idea is simple: decide in advance while you're calm and rational exactly what drawdown level triggers a mandatory stop. Okay, a common and reasonable threshold is stopping all trading for the week if you're down about 5% from your weekly starting balance, or stopping for the month if you're down 10 to 15 from your monthly starting balance. The specific number matters less than having one stat set before you need it. Deciding this is the middle of losing streak when emotions are already running the show, defeats the entire purpose. Once you hit that threshold, the rule isn't take a quick breather. Okay. It is you get out of the market, you rest at minimum, the rest of the trading day, often the rest of the week or the monthly level breach, you need to stop, okay? Okay, so here's the part people will skip, the cool-off period. Okay, the cool-off period is very important. You reach it, you leave, and you stop trading. Okay, so the psychology of preservation. Why capital preservation beats capital growth at first? Let's close today by talking about the mindset, because everything we've covered, position sizing, risk to reward, drawdown limits on works if a psychology behind it holds up. Here's the core idea I want you to leave with. Okay, in the early stages of a trading career, your actual job is to grow your account as fast as possible. It's to survive. It is not that, okay? It is to Nobody cares how fast your account grows if you cannot even survive a year. It's okay, so your job is to survive how long that your edge, assuming you have one, gets the sample size it needs to actually play out. So trading is a game of probabilities across hundreds and thousands of trades, not a game you win or lose based on this week. Okay. So survival is the real first year goal and growth is the second year problem. Okay, that's why when people say, oh, if I just started trading last month, I'm gonna be rich. Okay, no, please stop it. Okay, so recognizing the urge to get it back, FOMO after loss versus FOMO after a missed trade. If you at any point of time feel FOMO, you know what? Just close the charts, close the screen, stop it, and then just walk away. Okay, the telltale signs of revenge trading. Okay, it's terrible. Okay, it is terrible to have this feeling. So for me, what do I do? When at any point of time I feel this way, I immediately leave. I immediately leave my charts. I immediately turn on my computer and I stop trading completely. Okay? So a 15 minutes rule that works is to allow you, okay, close the platform at a minimum step away from the charts for at least a full 15 minutes before you are allowed to look at another trade or before you can allowed to even open the charts back. Okay, that's the minimum you are allowed. Okay, building a preservative mindset you can actually keep. So journal every trade, not just losses. Treat trading like a business with controls. Okay, rules will beat willpower over the long run. Okay, it will be willpower over the long run every single time. So please have a set of rules. Okay, please have a set of rules. Please get it done. Okay, so that's all I have for you guys. Today. Okay, thank you so much everyone for joining today's session on risk management. If you take away just one thing, let it be this. Your job as a trader isn't to be right all the time. It's to stay in the game long enough for your edge to work. Size your position off your risk percentage, judge trades on risk to reward, respect the math of drawdowns, and build rules that you can actually follow even on your worst days. So I'll hang around for a few more minutes if you guys have any questions, and then if not, I'll just end today and I'll see you guys next week. Okay? Ask me in the chat box if you have any questions at all. Okay, cool. I see that we nobody has any more questions, so I will see you guys in later at 3:30 Singapore time to do the live trading session, okay? Okay, bye everyone. Take care. I will see you guys later. Bye.